Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. As we begin a new year, end one year, begin a new year, a lot of people start thinking about investments, about how much money they have, about their financial plan. And so I thought it'd be really interesting to check in with an expert in investing. I want to introduce you tonight to Benj Gallander. He is widely considered to be Canada's top authority on contrarian investing. So we're going to have to understand what contrarian investing is all about. In the best seller Market Masters interviews with Canada's top investors, proven investing strategies you can apply, Benj was number one of 28 people on the list. His 10-year annualized return is above 19%, and it's the key reason why he has that reputation. Benj Gallander, welcome to the show, sir.
It's a pleasure to be here, Brian. Thanks for inviting me.
So off the top, tell us, if you could, what the heck is contrarian investing?
That's a good question. We buy into companies that have been badly beaten up. So we're looking at turnaround situations. So they're companies we figure have the possibility to increase in value by minimum 100%, often 2, 3, 400%. None of it is pie in the sky. The initial sell targets that we have are always based on where the company's traded in the past. So we do things somewhat differently. A lot of people, they don't like the way we do things because we're buying into companies that are beaten up, that have problems, but we feel that we're buying into companies that have a tremendous potential for a turnaround. So it's contra what many of the mutual funds, brokerage firms do, where they're buying into companies that are very successful at that point in time, and they feel will go up some percentage. We're buying into companies that used to be very successful or have been somewhat successful, have been beaten up, and we think can, as I said, return to form.
So why would it be out of favor? I thought the whole idea was buy low, sell high.
Yeah, I agree with the buy low, sell high, but as you know, companies sometimes have difficulties, so that knocks down the stock price. Or what I even prefer is when the whole stock markets, when they get beaten up badly. So often when that happens, companies that really are doing okay, they get hit too. The stock price gets beaten up because often people knock down stock prices indiscriminately. So we're looking definitely to buy low, sell high. And as I said, often with huge gains.
Well, that sounds actually very constructive to me. I think that short sellers get a lot of bad rap. But what they're doing there is they're taking companies that should be, they think, in the trash, and they try to take it from the high down to the low. You're doing the opposite. You're taking ones that you think are actually pretty good, and you're investing them at the low and trying to build them back up.
Well, that's it exactly, and I think often they're not doing that well at that point in time. They often have problems. Look, short selling has a place. There's no question about it. I wrote in my first best-selling book, The Uncommon Investor, that I was working on a short selling method. And then I found for my second book, The Contrarian Investors 13, and the stock books, both bestsellers, I couldn't do it. Short selling wasn't for me. I did it once, and within about 2 weeks, I lost about 40%. And the problem with short selling is you don't know how much you can lose because the stocks can keep on going up and up. So as an investor, it's very important to assess what you're good at, emotionally, what works for you, psychologically, what fits into your wavelength, so to speak. And I found the best thing for me, having done this now for over 40 years, which is kind of scary, is to just find stocks that are out of favor and hope that they'll go back into favor.
Now, the stock market is at an all-time high. Can you find stocks that are out of favor in the current market?
There are stocks that are out of favor, but there's not a lot. We do most of our buying in December. So we do most of it when tax loss season is on. So what happens when tax loss season is on, of course, people are selling stocks. It increases the supply. It knocks down the price. And there we are at Contra the herd, ready to jump in and buy them. But I've been very actively looking for stocks to buy this buying season. There's not that many. I still haven't bought a full position on anything. So, we're very patient. And in the portfolio that I was managing is 15 to 25 stocks. There was Phil McKellar, the portfolio you've interviewed, Phil's, he has 15 to 30 stocks. We're not looking to buy a lot of companies. We're looking to have a diversified portfolio, but we don't want to have 50 or 100 because if you have too many companies, they play off against each other. I'd rather have a team of all-stars or potential all-stars than have a bunch of also-rans.
Now, when you're taking a look at one of these out-of-favor companies, do you get to know management? Do you interview management? How close to the company and doing due diligence on the company do you get?
Sometimes we interview management. Sometimes we get together. I'm kind of two minds of this, actually. Sometimes there's a risk that you get to know them too well and you have too much confidence in them. So I've had some companies where I've known management pretty well and there's been blowouts on them. But I do contact the company, contact management. Before I buy into a company, I'll have followed it for a minimum of 6 months, often for years. So I get to know the company very well over time, and that's absolutely critical. And in terms of what we get to know, we go over all the financials. We look at what got them into trouble, if they are in trouble. We're very, very careful and in depth in terms of what we study. So we don't do anything quickly. I don't do anything quickly. I am very patient in terms of what I buy. I like to know the company very, very well. I'll talk to other people in the field. In our little firm, Benj Gallander, who I've been friends with for, we met at the University of Western Ontario way back when. Phil McKellar, it's a number of other people we'll talk to. So we feed things off of each other. But again, I don't buy anything fast because I find if I buy something too quickly, I just won't know enough.
If people want to subscribe to your newsletter, is that possible?
Oh, absolutely. They can go to our website at www.contratheherd.com. It costs $680 a year plus tax. We send them 4 copies a year, a quarterly, which talks about most of the stocks in the portfolio. Where a lot more of the value comes in is whenever we buy a stock or we sell a stock, we send out an email of it. And then we keep people apprised. Also, people are welcome to contact me at my email address, gall@pathcom, pathcom.com. I respond to emails usually within 24 hours. They can phone us, 416-410-4431. And the reason I'm laughing is we don't get many phone calls anymore. And at my house, I still have a landline. Some people think I'm a dinosaur, but it's comforting, Brian, to have it on my desk. So that we're very happy to talk to people, very happy to communicate with people. I thoroughly enjoy that.
And if people want to invest with you, how do they do that?
Well, they can't. We get asked all the time. And if we were, Ben and myself, say 30, 35 years old, perhaps we would have started a fund. And we've been asked by some of the funds to manage funds. At this stage in our careers, both of us are either senior citizens or very close to it. We just don't want to deal with that kind of thing. We've set up a fairly simple system in some ways with the quarterly releases, with the buys and sell on the stocks. I should mention too, we also send emails when there's a takeover on one of our companies. And we've had an inordinate amount of takeovers over the years for fairly small portfolios. for people who go to the website, they can see how many we've had. And I mean, proportionally, it's huge, absolutely huge. And that's a fabulous way to make money because virtually always, not always, but virtually always, the takeover offers are at a premium. And the best thing is when you get a bidding war going, which sometimes happens. I wish it happened more often, but that's where you can make tremendous returns. And a lot of the stocks, virtually every stock I buy is under $10, often under $5. But say we'll buy stocks that traded at $50 for under $10. And if we're buying them at $2.50, say, when it hits $5, then some of the other investors can move in on them. When they're over $10, say mutual funds, stock brokerage firms, and they can start the stock moving. And one of the things I love, it does not happen enough, is when a stock I buy, say at $1.25, later on goes up by more than that in a day. So it's buying stocks of low dollar value can be very, very, very good way to make money. What you have to do is watch that you don't get caught in a stock, and it's just false. It's just a stock you think has a chance to return, but it's just not going to return to form. And that's one of the reasons I like to follow the stock for a number of years, as I said, a minimum 6 months before I buy into it.
Fascinating strategy. We're chatting tonight with Benj Gallander, a contrarian investor. We're going to take a break for some messages and come back in just 2 minutes with him and understand a little bit more about this contrarian investment strategy, how successful it's been, whether above 19% is what one might expect or be able to hope for following such a strategy. Understand a little bit more about why stocks get out of favor. Stay with us, everyone. Back in 2 minutes with Benj Gallander. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking tonight about contrarian investing with Benj Gallander, who's widely considered to be one of Canada's top authorities on contrarian investors. Market Masters has said he is the number one of 28 different people on their list of proven investing strategies. His 10-year annualized return is above 19%. Sounds pretty attractive to me. Benj, let's talk about a couple of things about you to start with. What did you do before you got into this business of contrarian investing?
Well, I went to the University of Western Ontario way back in the day. And even when I was at Western, so I was there at 18 years old, I started investing back then. Then between Western and Dalhousie, I took 3 years off. But I traveled a lot. I did all kinds of jobs. Then at Dalhousie, I got my MBA degree, International Business and Marketing. And I've always thought part of education can be living in other places. So for me, living on the East Coast was fabulous. Made a lot of friends, got to see a lot of sights, hitchhiked through the Maritimes, that kind of thing. And then I wasn't a typical MBA. A lot of my friends went to work for stock brokerage firms, oil and gas companies, banks, and I just didn't really do that. I did some work for some smaller companies, and I traveled a tremendous amount. I went and worked overseas. I led bike tours in France. I also led them in British Columbia. I went and worked in the Middle East. I basically did all kinds of stuff that wasn't typical MBA. I remember getting together with my buddies a few years after MBA, and not many of them were very satisfied with their jobs. Of course, they were making a lot more money than I was, but I was happy. Actually, my first job really after the MBA was I worked at the International Hostel in Toronto. And I was managing the hostel. I was making minimum wage. And when I got a boost of $0.25 an hour, I thought, woohoo, I'm in the money. But it was a great job. It was a great way to meet people. It's a great way to travel later on and visit with a lot of them. So it's quite a mixed bag. And, even in my way of life, I've always been a contrarian. And Ben and I started the investment letter almost 30 years ago. We talked about it for a little while and we decided to give it a go. So actually, a gentleman I dealt with at the bank at TD, he was the first one to sign on, and it took us a year before we got a second subscriber. And I still remember, quite frankly, when this gentleman called and he said, "I'm interested in subscribing." We only take 1,000 subscribers. Unfortunately, we're under that number now. And he asked if we had any space for him to sign on, and I said, "Hold on a second." So yes, we allowed him to double our subscription base. But then there were articles in the Globe on us and the National Post on us, and then things really managed to take off. But we really don't do any marketing. I mean, I write for the Globe and Mail, as does Ben, as does Phil. Um, I go to some shows. Sometimes we set up a booth, but we don't do that all that often. But we just don't market in the way that a lot of consulting firms do, in the way that a lot of investing firms do. We sometimes consider ourselves to be two guys in a garage. Now, fortunately, we both live in pretty nice garages and we have fabulous lifestyles. Um, and we're very happy, and our families are both very happy. So, what more could you ask for?
Not
Yes,
much. That's for sure. That's not that's fantastic. I understand that you've also got a gig writing plays.
yeah. Back in 1991, um, there was a Fringe Festival was on. Fringe Festival continues to this day. And myself and a number of friends, we all applied to get in, and none of us got in. It was based on a lottery. The odds of none of us getting in, it was possible, but it wasn't all that high. And we knew there were a lot of other people who wanted to put on plays, and they had nowhere to do it. So Ben and I decided to get together. We hadn't got together in a little while. And then another close friend of his who became a good friend of mine, Rob Sherwood, he said he wanted to get together. And Greg Holmgren, the four of us had talked about going and drinking for quite a while. He got together, as did Carol Pauker. And we decided to start this theater festival called Summerworks, which still goes on today. It's one of the largest festivals in Canada. I go and visit, but I'm not really involved at all anymore. And so, since the festival was going to go on, it gave me a fabulous medium to put on a play. So, the first play I wrote was called The Death of Parent God. It's funny how things work, Brian. I had visions of it eventually going to Broadway. Um, the actor, the director, put it on the street after it was on at the Terry God Theater. But then I had 5 other plays that were on. Some did
500 plays.
no, 5 other,
Oh.
five, 5 other plays. No, and some of them did pretty well. Some didn't do that well. Uh, it was a lot of fun to do. I'm still a member of the Playwrights Guild. I'm still doing some writing, but I'm not doing any theater.
And you've written 2 best-selling books. Tell us about each one of those books, if you could.
Well, I actually wrote 3 best-selling books. The first was the Canadian Small Business Survival Guide, which is still out there and has had 14 printings. It's been modified over the years. The Uncommon Investor is basically it's a conversation between friends and family while they watch the 7th game of the World Series, the Toronto Blue Jays versus the New York Mets. I've been a big baseball fan. I played tremendous amount of baseball until about 3 years ago. A number of years ago, I played for 4 teams. Way back when, I tried out for a number of teams, but don't make too much of it. They were open tryouts, like the Blue Jays had, the Expos had. I went, didn't go anywhere. So I wrote a book, a conversation between people, and all about investing. So it outlines the methodology that we use. After that, I wrote the Contrarian Investors 13. And basically, it's 13 chapters with 13 rules that we use when we invest. It did very well. It was a bestseller in hardcover, bestseller in paperback. I still have some hardcover copies here if anybody wants to order from our website. Yeah. Um, so I really enjoyed writing the books. They did very, very well. I sometimes think of writing another, but I don't have any real plans to write a stock book. I've been working a bit on a fictional book. As a matter of fact, I was just the writer in residence in East End, Saskatchewan, population 500 and change. And they were kind enough to give me a house there to work out of. Um, After I go on this Christmas trip, I'm going to come back, and a book that I was working on there, I'm going to try and develop it further. I don't know if I can actually do it and do it really well. It'll be a good challenge for me, and it's great for all of us to challenge our minds, especially as we get older, to keep both those hemispheres working and tweak them. So I think I'll get back to it when I'm back from the next trip.
So you've been a world traveler, and you've worked in different countries around the world. You have been a playwright, and you've launched a festival, a summer festival, and you've been involved in writing plays. You've published books on investing, and you're actually dabbling in fiction as well. Why become a stock picker?
When I was a kid, I was probably overly interested in money. I think it was too consuming in some ways. And a friend of mine, he was investing in stocks, and he became a stockbroker when he was about 21 years old. I used to go down to his firm sometimes and watch the ticker and talk to the old men, so to speak. I guess I'm one now. But the key was to possibly make money. And that was what it was all about. So, when I started, I had very little money to invest. I would go down there to the stock firm, and I would look at value line. I would read up on the companies. Of course, investing then was very different than investing now. Doing research then was very different than now. The internet has changed everything. So money always interested me. And, at the end of my first book, the first stock book, it finishes off with money often costs too much. So money has a place, a roof over your head, food, go out, enjoy yourself, travel, etc. But if one becomes too consumed with money, if one rips off other people, if one is dishonest, that's when it's a big problem. And we know a lot of people like that.
Well, we sure do. As you traveled the world, worked around the world, met a lot of different people, have you found that helpful? It sounds like you're a reasonably curious individual, and that you get to understand people.
Oh, absolutely. You get to understand people, you get to see things, you get new ideas. When I worked in what was called Czechoslovakia in 1982, I was there to teach 92, excuse me. I was there to teach English, but they knew that I had an MBA. And I was working in a factory called Mezmolnica, where they made motors for washing machines. And they asked me to help them out. Of course, it was brand new times. It was right after the Velvet Revolution. So I could give insights into Western economies, how to market to the West, etc. But being there and living with those people, and I was living in a small town of about 10,000, I got tremendous insights into what was going on there. I went to university in France, in Chambéry, for a year. The goal was to learn French, which I did to some degree. I gained insights there. So the traveling makes one a broader person. One learns things. Myself and my better half were just in Portugal for 4 weeks. It was fabulous. I mean, you saw all kinds of different things. We ate great food, but I continue to travel. It's interesting. I wrote a poetry book once called the MBA Hobo Poems. It's about this thick. You see, it's tiny. It never sold a lot of copies, but I was looking at it the other day, and on the back page there's a picture of me and the graphic designer, because each poem has a picture, and on the back page it says, "One day I want to go to Iqaluit." It was a dream. And actually, they invited me to speak at a mining show this past spring, which was fabulous to go to. The problem was, Brian, I went to visit Cape Dorset, which has another name now. And then I couldn't get back to Iqaluit for 2 days after I was supposed to come back and speak because of the weather. So fabulous trip, amazing experience.
But you missed your speaking opportunity.
I did. I'm hoping they'll invite me back. I did get to spend a couple days at the conference, but no, I didn't get to speak. I was all prepared. Everything was ready to go. Life doesn't always work out as we hope, make lemonade out of lemons kind of thing. And a key thing in investing too, if you've got a stock that's not doing well, is the best thing to do is to chop it and get rid of it? Or is it to hang with it? It's the best thing to do, perhaps double down, average down. So, and that's key. Once you have these stock positions, doing the best that you can with them. And a lot of people throw in towels. If you throw in a towel, you have to have good reasons to do it. But constantly analyzing stocks, thinking about what one's doing in life. And you and me both know life is very finite. And the two of us have, at least me for sure, less time ahead of us than we had behind us. So the question is, how do we get the most out of this life that we have? I'm working on that every day, my friend.
I think it's a good occupation. But I want to take a break and actually come back and talk to you about some of your 13 chapters and the 13 different strategies and a little bit more about your methodology. So we're going to take a break for some messages and be back in 2 minutes with Benj Gallander of contrarian investing called Contra the Herd investment letter, and maybe understand a little bit more about exactly what the methodology is and how he does it. Stay with us, everyone. We'll be back in just 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Benj Gallander. He is with an organization called Contra the Herd Investment Letter. He is a contrarian investor, and he's got a really interesting background. He's traveled the world. He's worked around the world. He's been a playwright. He's written a book of poems. He's written some fiction. Sounds kind of fascinating. I think he's met a lot of different people, studied a lot of different companies, and he knows, at least he thinks he knows, and given his results, I guess he really does know about how to invest. And he's got 13 different philosophies that we're going to walk through and understand. Number one is concentrate on turnaround situations in stocks which are currently unpopular but are likely to regain their luster. How do you find those?
The first thing I do is a filter. So I'll look at every stock and the TSX, NYSE, NASDAQ, that has come down at least 33% in the past year. So that's the first thing. And it's so much easier to do now than in the old days. I used to have to go through the stock listing one by one. So by doing that, I'm finding companies has been badly beaten up. Some of them far more than others, but they have to be down at least that 33% before I touch them.
So you're not looking for a brand new company that's got a growth opportunity. You want something that was successful in the past and is down by at least a third.
Yeah. And one of the things is too, I only invest in companies that have been around for at least 10 years. So that means I can't buy anything newfangled and exciting. So when you have the different crazes like marijuana or crypto, back in the day, technology companies, I couldn't buy into any of them. They just did not meet my criteria. I want companies that have been established and have a track record. So that's absolutely critical for me, because To analyze new companies, it can be done to a degree, but it's more difficult. And often with the new companies, there's so much hype around. And you and me, we've both seen this many, many times. So, say for marijuana, people jump into all of these companies. There's a few that are successful, but most of them aren't. Technology companies, how many actually make it? Go way back to the automobile industry when it started. Most of the companies didn't go anywhere. So I want to know that there's a track record and that there can be a return to form.
Number two is focus on stocks that have the ability to increase in value by a minimum of 50%.
Yeah, I really normally look at 100%. So they have to have tremendous, tremendous upside. Again, it's all based on where the companies have been before. So I'm not saying this company's at $4 now. I think it'll hit $12 unless it's already been at $12, often for a number of years, or perhaps it has a spiky graph and has gone up, say, 3 times in the past 10 years over the $12. So it has to have that history. It has to have that tremendous upside. It has to have achieved that upside in the past.
Number three is carefully analyze corporations' financial statements, concentrating on debt ratios and book values. Why book values?
Well, if a company has a good book value, and I mean a book value that's not all in goodwill, if I'm buying a company that's for $4 and the book value is $9, that says something right there about the assets that they have. You have to watch out for that a little bit because sometimes some of the book value is in equipment, et cetera, that's no longer any good. But book value is important.
And what about the ratios?
The ratios are critical, absolutely critical. And debt, as you mentioned. One of the reasons I had difficulties with companies in the past was often I would buy companies with too much debt. And of course, doing this for 40 years plus, I've learned over the years from my mistakes. Debt is what often kills companies, people, etc. So I look to avoid increasing debt loads. I like to see that debt has leveled off. I look at the debt relative to the revenues. I like to see the debt has gone down. And sometimes I can buy into companies that are quite good that have no debt at all, no long-term debt. And it makes it much harder for them to get into problems in. I did have one years ago, Glendale. They made vans and they had zero long-term debt and everything looked good. And I bought into it and it went bankrupt and I lost the whole investment. So if you want a perfect system, there isn't one. And there's a lot of people out there who will tell you that theirs is perfect. I know the foibles we have. I've seen the difficulties and where we make mistakes. So we're at the point now where what we do is try and make far less.
Most people look at debt to cash flow or income or EBITDA. Why would you look at debt to revenue?
Well, because if the debt is too high and you have to service that debt, but I look at the metrics that you just mentioned too. But if you've got a company with $100 million in revenues and $200 million in debt, that's often a red flag right there. But what you're saying is absolutely true. Debt has to be looked relative to a number of other things.
Number four is analyze management's ability to achieve stated goals. How do you do that? Do you go interview the management? Do you look at their resumes? Do you do what do you do to analyze management's ability to realize goals?
Well, we'll look at their history and see if they've been with other corporations that have turned around. They've turned around. If they've done that, that's a good indicator they can do it again. Sometimes we'll meet with management or talk with management, as we talked about before. But sometimes we're mistaken. Remember one company we invested in, the CEO had done a tremendous turnaround in another company, and then this one, he didn't do it, ended up going bankrupt. So we want to have an idea that the people at the top really know what they're doing, but it's not always easy to get that information. You read their bios online, you can talk to them, but it doesn't necessarily give you a lot of depth in terms of what they can possibly do.
Charlie Munger, Warren Buffett's partner who recently passed away, I think had a saying that I can't remember exactly, but it was, I'd rather buy a good company with great management than a great company with poor management. So he really believed that management was key. Do you agree?
Oh, absolutely. If you have bad management, Charlie and Warren, I admire them so much. Ben and I went to the AGM about 15 years ago, and it was fabulous to be there. Just fabulous. So what I did this year, I took my two lads who were 23 years old and 19, and I thought, we better go now or soon because who knows how much longer Charlie and Warren will live. And as we know, Charlie died recently. Tremendous minds. I remember being at the AGM again 15 years ago, and Warren would start to answer a question. Then Charlie would add some pithy comments, brilliant comments, and then Warren would talk. I mean, these two individually and as a combo, they demonstrate the idea of synergy. 1 + 1 = 3. And I'm so glad I got my boys there for the meeting. And I don't know what the meeting will be like next year, but Omaha, Nebraska is a pretty cool place to go.
Number 5, invest only in organizations that have existed for at least 10 years. Why only 10 years or more? Why not little companies, early stage?
Well, we've talked about this a little bit. I can't understand those companies well enough. They don't have the history. By looking at a company with a 10-year history, I've got something more to go by. And for me, that's absolutely critical.
Often pick takeover candidates well before takeovers occur for near optimum returns. How do you know that it's a takeover candidate if it hasn't been announced yet?
Well, I don't know, which I can know, but sometimes it's in the news that might have been 3 years ago. One company made an offer to take over another company, and the other company rebuffed the offers. Sometimes that the company, the suitor, comes back. So, and then they'll probably come back at a higher price. So that can be a good indicator. Now, often companies put themselves up for sale, or at least sometimes. Sometimes it's companies that are going well. Sometimes it's companies that are doing horribly. So, I read tremendously. And, Charlie and Warren, they read tremendously. I get the Globe and Mail delivered to my doorstep still, a bit of a dinosaur that way.
You and me both.
Yeah, I read it with breakfast. I lie on the couch after. But sometimes there's little hints. But often enough, it comes as a complete surprise. Somebody comes out of the blue and puts in a takeover offer, and we're happy to accept it if the price is good.
I like this one because it's sort of similar to a rule my dad gave me before I went to Vegas. You say you normally sell a minimum of 50% of the stock upon achievement of your target, while market timing the remainder. I'm not suggesting that what you're doing is similar to gambling, but my father told me as soon as you make your money back, take it off the table and don't make use of it again.
Yeah, it's good to take some of it off the table. There's no question. My dad and I made an agreement when I was, I don't know, 14, 15. He would take me to Las Vegas at 21. I made an agreement with both my boys that if they didn't smoke or get a tattoo until they were 21, I would take them on a trip anywhere they want to go in the world. So I just took the older one to Japan. I have nothing against tattoos. I just didn't want them to get them at 16 years old and after think, oh my God, oh my God. So I got to go to Vegas with my dad at 21. And I actually thought that perhaps I'd be able to make a living counting cards. Ben and myself thought we might make a living on the ponies. I quickly learned I couldn't do it. I lived in London, Ontario then. The odds against us were like 17%. Blackjack at the casinos, and it was easier back then because you could go against one deck or two or three. Now I think it's often 6 or 8 decks, and sometimes they shuffle after every hand. So it really minimizes the odds. So the last time I was in Vegas, I only played a few hands, but I saw some great shows. I love the city, and my dad liked to go too.
But take something off the table is one of the keys in your investment strategy. When you reach target, get 50% sold.
Yeah, when it can take some money off the table. Sometimes I'll wait a little longer. For example, if one of my companies hits the target in December, I will wait until the next year because I want to do this thing called tax deferral. And taxes are absolutely important, playing that game correctly. Bit of a fixed game for the government, but we can play it as well as we can. So yeah, I like to take some money off the table. Sometimes I'll sell 100%, sometimes 75%, but normally at least 50%. You know, I know how easy it is for me to make mistakes. And one of the things I like to say is don't fall in love with the stock. They won't love you back. They're just a tool for a standard of living. That's all they are.
Don't
And
fall in love with the stock. Sounds like a good adage. We're going to take a break for some messages and come back with some concluding comments in just 2 minutes. Stay with us, everyone. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Benj Gallander about Contra, the Herd newsletter, and contrarian investment. Benj has got a best-selling book with a whole bunch of philosophies, and we're down to the top or bottom three. Practice patient investing while ignoring the daily pulse of the market.
so I look at the market every day and I read a lot every day, but we're patient investors. Years ago, we checked the average hold time. I think it was about 3.5 years. I think it's even higher now. So I by setting an initial sell target, it grounds me. So I'm not blowing with the breezes on stocks. It's bad news, it's good news, etc. I'm watching it, but very, very patient. I've held some stocks for over 10 years easily. I remember holding 2 funeral companies for over 10 years, but the returns were 400, 450% plus. And if you do that, it doesn't matter if you hold for 10 years, your returns are absolutely fantastic.
Advocate diversification.
Yeah, and one of my chapters is diversify, but don't over diversify. Too many people buy into too many things, as I alluded to before, that hampers returns. So I like to have between 15 and 25 stocks as a general rule. That gives me, I think, the biggest bang for the buck. I do have more now because I own some prefs. But even when I buy prefs, I buy them with the possibility that they'll go up at least 50%. If I'm buying a pref share that came out at 25 and I'm paying 12 or 14, that gives good upside and great dividends. So being patient to me is absolutely critical.
And the last one was exactly that. Appreciate stocks that pay regular dividends. Why do you want dividends?
Dividends give me a return on investment. Now, years ago, I read when the dividend is paid, the stock price often comes down, equal to some degree to the dividend, less 0.5%. So you still have half percent on the upside. I like to get some money out. Companies that pay dividends are often more solid than other companies. To me, it just makes sense. I have actually a scale with all of these stocks on them. It's the stocks that I'm really looking at. It's a point tally system, effectively, and the stocks have to get over 10 points for me to look at buying them. 14, 15 is better, but dividends is 1 point in the system. But yeah, I like having that payout.
So that's interesting few rules. Thanks for sharing them. Is this contrarian investing similar to value investing, the Ben Graham sort of philosophy?
Yeah, great question. Yep, we're value investors. It's tied in, and I read Security Analysis, his book, twice years ago, But there's no question we're big value guys. The question, though, is what is value? How do you find value? How do you measure value? And we've got our way of doing it. So absolutely critical.
So in Finance 101, you learn that the market is efficient, and all the information that's out there is already out there, and there's no real opportunities in the marketplace. And a bunch of people, lots of analysts say, just invest in the market, just invest in a mutual fund that buys the market, and you'll do the best. Don't try to pick stocks. You obviously feel differently than that. Why?
Yeah, I remember when I was doing my MBA having a debate with Alan Rugman, one of my professors, and he was all the market is perfectly efficient and it cycles its way through universities. And I said, no, it isn't perfectly efficient. And I was already doing well. And how can it make sense that something that has so many people involved can be perfectly efficient? It simply can't. Information comes out at different times. People don't get it at the same point in times. I just thought that was hooey, that it was perfectly efficient. I remember a friend of mine who was a currency trader. He was doing MBA. He'd come back for it. And he said to me, Benji, which is what I was called back then, why do you bother to debate the professor? And I said, I don't know. It's just something in me. I just have to do it. Um, it's not perfectly efficient. It doesn't make any sense. If you look at anything in life, how many things are perfectly efficient? And something with so many moving parts, how can that be perfectly efficient? It makes absolutely no sense. And while I say that, I'm sure the universities will keep on teaching it in some places.
If people want to get your book or subscribe to your newsletter, sir, how do they do that?
Best thing to do is go on the website, Contra, CONTRA, the herd, THEHEARD.com. They can subscribe there. This is actually a good time of year to do it because we're doing our buying right now. And if they want a copy of the book, they can also go online. They can send me a bank transfer, an e-transfer, and I'll pop a copy in the mail. If they want to give it to a friend, I'll do that. I'll even autograph it, although I kid sometimes that lowers the value.
You know what? This has been a really interesting conversation. I think a lot of people need to think through the research that they should do, the thinking they should do before buying stocks, rather than just buying something that matches their fancy at a different time. Because I think a lot of people, think about venture capital, think about momentum buying, think about just buying companies that they're familiar with. But what you've done a good job of is talking through the principles that you apply, the methodology that you applies to value investing. So I really appreciate you chatting with us today and sharing your strategies.
Well, it's been great. Investing in stocks isn't brain surgery, but you have to take time. You have to do a lot of reading. You have to think about it, analyze. And for people who haven't done a lot of investing or any, you might want to dip one toe into the pond, so to speak, and gradually get your bearings. And then over time, do more investing.
Benj Gallander of Contra the Herd Investment newsletter. Thank you so much for joining us. Really appreciate it.
Thank you, Brian. It's been a pleasure.
That's our show for tonight, everybody. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and videos are available on my website, briancrombie.com. Good night, everybody.